Good afternoon, everyone. Welcome to the U.S. Energy Information Administration's first in a series of workshops that will explore trends and expectations surrounding the outlook for energy markets. Today, we will discuss macroeconomic and energy sector demand. We are very excited to have several distinguished panelists joining us. Thank you to them for agreeing to be here and sharing their thoughts and insight. These workshops are very important to us, and we are joined today by both Administrator Linda Capuano and Deputy Administrator Steve Nally. My name is Nicholas Chase, and I'm the team lead of EIA's macroeconomic analysis team. EIA is a statistical agency within the U.S. Department of Energy. Our mission is to provide independent and impartial data and analysis that can be used to better understand how energy markets function and make more informed decisions. I want to review a few housekeeping items. We will be recording this webinar. A link to the recording will be sent to all participants once it has been uploaded to EIA's website. To avoid background noise, all attendees have been placed on mute. There will be a Q&A period for each session. You can submit your questions at any time using the chat function in the WebEx control panel. Please make sure you direct your questions to all panelists. We will do our best to follow up with you and any questions we do not get to today. I want to thank Kelsey Brazier and Elizabeth Sendich of EIA for helping monitor and run the WebEx and Q&A here today. This has been an unusual and an extraordinary year. At EIA, we know that creating energy market forecasts and projections is always challenging. Yet the COVID-19 pandemic and the global response to it continue to have broad impacts on economic activity and energy markets in ways that complicate the analytical landscape. These workshops are a way for us to better understand this dynamic landscape and the factors shifting and shaping it. Our workshop today has 3 sessions. The first 2 sessions focus on macroeconomic discussion. The first covers domestic U.S., and the second covers the global economy. I will be moderating these sessions. The third session discusses U.S. energy demand. My colleague John Maples will moderate this session. In our first session, we're fortunate to have 2 distinguished guests. The first speaker is Joel Prakken, who is Vice President, Chief U.S. Economist, and Co-Head of U.S. Economics at IHS Markit. Prior to IHS, Joel co-founded Macroeconomic Advisors and worked for IBM, the Federal Reserve Bank of New York, and held faculty positions at New York University and Washington University. The second speaker is Paul Ashworth of Capital Economics, who is Chief North America Economist covering the U.S. and Canada. He has worked for the National Institute of Economic and Social Research and has degrees in economics and mathematics and a PhD in monetary policy. In 2010, he was named the Wall Street Journal's Forecaster of the Year. We are thrilled to hear their thoughts. So with that, I would like to pass the discussion over to Joel. And for everyone's information, Joel is on audio and not on video.
Chief U.S. Economist here at IHS Markit, and I'm here to share with you a few summary remarks about the IHS Markit view on the U.S. economic outlook. But before doing so, let me say I hope you're all safe and well in these troublesome and unusual times. And I also want to congratulate you with pressing forward with your workshop series. I know that we're all preoccupied now with the immediate consequences of the pandemic, and that concern is pressing, but we shouldn't lose sight of some of our important longer-run considerations, and one of those is, of course, the role of energy in the U.S. and global economies, and how the macroeconomic outlook can impact the energy industry itself. Let me begin with a brief recap of recent economic events. As the COVID infections swept through the U.S. this winter and early spring, our economy shut down, and consequently GDP in the U.S. contracted at a 32% annualized rate in the second quarter. This was by far the fastest quarterly decline on record and threw the U.S. economy into the 11th recession since World War II. Approximately 15 million Americans are unemployed and perhaps another 8 million are underemployed. And while the epicenter of the downturn was in our service economy, every major sector, including energy, was adversely and severely affected. In response, our federal government has approved nearly $3 trillion in aid for businesses, households, and states. And the Federal Reserve has cut its policy rate to 0, rapidly increased its holdings of U.S. Treasury securities, and has created, or in some instances recreated, a variety of lending programs intended to maintain normal functioning in financial markets while channeling credit to worthy borrowers during the pandemic. Now, we estimate that without these policies, the level of GDP in the middle of next year would be about 5% lower than otherwise. But confidence bands around such estimates are, in fact, quite wide. The high-frequency data that we're tracking now show that a recovery began in the spring as many of our states began reopening their economies. And that recovery was initially strong enough to leave GDP positioned to grow at about a 30% annualized rate in the third quarter. We'll find out about that in another month or so. That's the good news. The bad news is that it now appears attempts to reopen the economies were probably premature in the sense that our government did not take the steps necessary to slow the spread of the virus during the economic shutdowns. After June, COVID-19 infections and deaths surged to new highs. States paused or backtracked on their plans to reopen their economies, and that same high-frequency data now suggests the recovery has lost some momentum. Furthermore, while reported cases fell through August, they've since turned up and are expected to climb higher with the arrival of cooler fall temperatures, activities moving indoors, and the opening of schools. And one lesson already learned from this experience is that the virus is the boss of the economy and not the other way around. It simply will be difficult to sustain an economic recovery without bringing the pandemic under control. So any forecast for the U.S. economy is dependent on assumptions made about the course of the pandemic. Well, in that case, what does our base forecast assume about the course of the pandemic? At IHS Markit, we're fortunate to have a world-class life sciences team that is carefully tracking global progress towards a vaccine. That progress is occurring at record speed, at least by historical standards. And the team believes the chances are good that a fairly effective vaccine can be developed by mid-2021 and fairly widely distributed by the middle of 2022. This could be critical for taming the pandemic starting next year, and our forecast is based on that presumed success. But that still leaves a gap of almost a year during which the economy is likely to experience sporadic flare-ups in the virus and spot closures of particular regions and industries. And the particular concern is that during that year-long gap, previously enacted fiscal stimulus will be exhausted. This is raising concerns that later this year or early next year, there might occur an economic relapse, a bounce and fade, if you will, or even a double-dip recession, accompanied by a serious deterioration in credit quality that could turn an economic crisis into a financial one. Fortunately, as messy and chaotic as our political process seems right now, I still do expect our Congress to enact additional measures of fiscal support to build a fairly sturdy bridge over the COVID abyss to the time that we have an effective vaccine. And of course, our Federal Reserve will maintain an extremely accommodative monetary stance for years to come, with interest rates at historically low levels for a prolonged period of time, and little to worry about on the inflation front. Nevertheless, the process of recovery will be slow. The assumed vaccine may not be fully effective. It may not be widely distributed as quickly as we wish. Some people may refuse to take it. The elderly and others at risk may remain very cautious about resuming normal activity. Given all this, I do not expect our GDP to regain its previous peak until early 2022. Nor do I expect our economy to return to low unemployment rates until 2024. Perhaps 30% of the jobs lost in just the last few months are permanently destroyed, and it will take much longer than that for the economy to invent new activities to reemploy those people. To put some numbers on this, our baseline forecast is for U.S. GDP to contract 4% this year, measured on a year average over year basis, and then grow at around a 3.5% rate both next year and in 2022. This recovery will be uneven. GDP goods, for example, is already above the pre-pandemic peak. Residential construction, which is benefiting from low interest rates and an apparent shift in living patterns from urban to suburban and even extra suburban environments, may regain its previous peak by the end of this year. But spending on socially dense services will take much longer to recover, as will investment in non-residential structures. And included in non-residential structures, of course, is investments in energy facilities, drilling rigs, etc. A word on commodity prices. They are rebounding with the global recovery. Our energy team sees the price of Brent breaking $50 a barrel by the second half of next year. It's going to be helped along, we think, by restraint in OPEC plus countries' output and a decline in U.S. shale production. What about the risks and uncertainties surrounding this forecast? I can imagine both optimistic and pessimistic scenarios around the baseline, but the balance of risk seems to me to be tilted towards the downside. It's hard to imagine an effective vaccine being widely available much sooner than mid-2021. It's much easier to imagine that the hunt for a vaccine is either futile or takes much longer than we've assumed in the base forecast. And in that regard, our life science team often notes that the average time to develop a vaccine is 5 to 7 years in the cases where success was achieved. There have been 6 previous strains of coronavirus, and there's not an effective vaccine against any of them. Many of our clients are particularly worried about a W-shaped recovery, with the economy relapsing into recession late this year or early next year if the virus outlives fiscal stimulus. And we also have a new kind of uncertainty to consider. This can happen again. Before 2020, the most pessimistic forecasters never imagined what has actually occurred. And I am left to wonder how that knowledge will reshape our allocation of resources going forward. I do expect there to be a persistent reduction in our standard of living. And I do expect the pandemic to cast a shadow forward on our longer-term growth potential. Some people at high risk may decide not to return to the labor force. Educational attainment may suffer if online learning proves to be less valuable than in-person learning, and there's already some evidence to that effect. Regional mobility within the U.S. and global immigration flows may slow. Given the cyclical downturn in capital expenditures, there will be less private capital available to support economic growth coming out of the recession, especially since new technologies are often embedded in new investments. And some of our existing capital, restaurants, theaters, our fleet of aircraft and rental cars, will be less valuable than before the pandemic because they were designed to be used under socially dense circumstances and likely will not be going forward. You can think about this as a reduction in total factor productivity. Larger government deficits may eventually...
This is Nicholas. We've reached the end of time. I know you've got a lot to say, obviously, on this fascinating topic. Hopefully, I want to make sure that Paul has enough time to go and have a little bit of time for Q&A. But yeah, more seconds. If you're able to kind of keep your wrap up here quickly, that would be great.
Yep. And international tensions, suspicions, and fears could linger for years, impending global commerce. So in consideration of all of that, we expect by 2030 that the level of GDP in the U.S. will be more than 2% lower than if the pandemic had not occurred. Okay? And that shortfall could actually easily be more. All right, so that concludes my remarks. I'm available for Q&A, and I'll hand it back.
Thank you so much, Joel. That was great to hear. We really appreciate hearing all your insights and thoughts, and that was quite a lot of information, so we're very grateful to hear it. And with that, I would like to pass it over to Paul Ashworth.
Yeah, thank you, Joel. The problem with following you is you've already said everything I wanted to say in the first place, but I'll try and add a bit more colour onto this. Here at Capital Economics, we broadly agree that, the initial recovery after the lockdowns were eased was probably a bit stronger than expected. It does look like third quarter GDP rebounded by around 30% at an annualized pace, as you said. But of course, that still means that the level of GDP is well short of where it was before the pandemic struck. As you correctly point out, the recovery is now beginning to slow. Indeed, we only have growth of 4.5% in at an annualized pace for the fourth quarter, and possibly slower even then as we go into 2021. Now, initially, it was the spending in the economy that turned around most quickly, we saw retail sales fairly quickly recover to its pre-pandemic level and has since gone above that. Joel noted how we've seen strength in housing as well, driven by low interest rates with home sales, housing starts, etc., all moving up very, very strongly. But some parts of the economy are still weak, in particular on the production side. So manufacturing output, for instance, is still well short of its pre-pandemic level. Of course, the unemployment rate is still elevated, and we still have a big shortfall in terms of employment. And of course, even with retail sales, we're now beginning to see a slowdown in the pace of the recovery. I think, of course, we saw a very major second wave of infections in the United States that was started around July. You're right, it might very well be that we're in the early stages of a third wave. What's interesting in the second wave is that the mortality rate was much lower and the number of deaths remained lower. And so for a lot of state and local governments, they felt more comfortable in not returning to the sort of draconian lockdowns that we saw in March and April. If we do see recurring waves of this coronavirus coming back, our hope is at least that the mortality rate will stay low. One, because treatments and drugs, for instance, improve that, and two, because the age profile of people becoming infected is now much lower than it was in the first wave, in which case the disruption to the economy might not be quite as bad as we had earlier in the year around March and April. But you're right, there are still significant downside risks from a resurgence, not just domestically here in the US, as I'm sure other panelists will note in the second session, globally as well. There are some upside risks as well. You talked, Joel, also about the possibility of a vaccine coming next year. But again, I absolutely agree. The key thing is that this is not going to be a silver bullet. It's not going to be fully effective, as in insulating 100% of the population. It's also going to take some time to deploy that. So it's something that will help to gradually improve things rather than turn things around overnight. Nevertheless, when it is announced and it is for real, I would expect that to have provide a significant boost to sentiment. And obviously, as we've got commodity markets as forward-looking, that might, give a shot in the arm to commodity prices at that time. One thing Joel didn't touch on is the outlook for inflation and general consumer price inflation in the US economy. It's interesting that the early stages of the pandemic were very strongly deflationary. We saw a big drop in commodity prices, oil. That obviously had a knock-on things like retail gasoline prices. And the worst affected sectors like airfares, hotel room rates also fell very, very sharply. But more recently, we started to see a rebound in some of those prices. And also, this is an unusual recovery in that spending has been leading production. As I said, retail sales are above pre-pandemic levels, manufacturing output is still below it. And that means that inventories look unusually lean for this stage of an economic cycle, where we'd expect producers still to be basically with an excess. So although the initial impact on inflation was deflationary, that's quickly begun to turn around, and we're now beginning to see more inflationary pressure, particularly relative to where we are in the economic cycle at the very early stage. So I think, for those that might be worried about deflation, this is not the recession that's going to bring us deflation, Japan-style deflation in the US. Instead, I think we're more likely to see rising inflation over the next year or two. Probably not enough to convince the Federal Reserve that it needs to abandon near-zero interest rates. But certainly I think the risks there are probably more tilted to the upside rather than the downside. Otherwise, we agree that GDP, after a 4% contraction this year, we have it growing by around 4.5% next year rather than 3.5%. And in a normal recovery, you might say that was a significant difference. But given the degree of uncertainty we have about, one, the vaccine, two, recurring waves of the virus, And the third element, which is the outlook for fiscal policy in particular, I wouldn't say those were significant differences. Obviously, part of the reason that the recovery has slowed in recent months is because of the expiry of the enhanced unemployment benefits that were paying recipients $600 per week. It looks like the chances of those being extended before the election have now pretty much dwindled towards zero. But based on the election outcome, there is still a chance of more stimulus, I think, to come next year. So I'd agree with Joel on that. Although there's, again, considerable uncertainty about the size of that. I mean, the $3 trillion stimulus we had this year is worth almost 15% of GDP. You know, even if we had $1 or $2 trillion next year spent within that 12 months, that could provide a very significant boost to economic growth in 2021, which would come above and beyond the sort of recovery that I currently have priced in our forecasts. And I think that's pretty much it, Nicholas. As I said, I think Joel covered most of the bases there, so I've just tried to provide a little bit extra colour, but I certainly wouldn't strongly disagree with anything he had to say.
Well, thank you very much, Paul and Joel, for these very strong remarks. We were quite happy to hear them. We did get several questions coming in from the audience, and we've got about 8 minutes. So I'll at least try to hopefully I can throw 2 of them out. I'm going to weave a couple of the questions kind of together. The first, there were some questions about which parts of the economy are likely to recover the most quickly or the most slowly, and adding a little bit of moderator prerogative here. If I could kind of weave in to that question, are we looking at any, from your point of view, any kind of medium or long-term scarring or changes to the domestic economy because of the situation? And we could start maybe with Joel and then go to Paul.
Okay, so I'm going to answer the back end of that question first. I did mention this in my remarks. For a variety of reasons, we expect the level of potential GDP a decade from now to be lower than it would have been, than it was in our pre-pandemic forecast by as much as 2 to 3%. Which sectors are going to recover the most quickly and which are going to lag? Paul and I both noted that the goods producing sector is bouncing back very strongly. In fact, goods GDP is already above its pre-pandemic peak. It's the service sector of the economy, particularly those components of spending that are sensitive to social distancing, where the recovery is going to be the slowest. Travel and entertainment, restaurants, theater, live sporting events, the like. So while some parts of the economy are very close to already having fully recovered, there's another part of the economy that is years away from regaining their pre-pandemic levels. And it's not even clear, what that new normal is going to look like when we finally do get there.
Absolutely, just to agree with Joel, it's the ongoing physical distancing measures that are having the biggest impact on sectors like restaurants, and also to some extent in personal services, and even in medical care with things like dentists and doctors' offices. It's adding to costs for businesses, and it's restricting supply. So those are some of the sectors that certainly we'd expect to see the longest of the lingering impact. The sectors that are doing best, some parts of the economy are enjoying very low interest rates. We highlighted in both our remarks that the housing market has done pretty well in terms of both new construction, new home sales, existing home sales, housing starts, all of these metrics, that's turned around to the extent that it's actually stronger than it was pre-pandemic. And even other interest rate sensitive sectors like motor vehicle sales have done relatively well. But then at the other extreme, you've got things like travel services still struggling, and that has knock-on impacts on other parts of the economy like aircraft production. So of course, firms like Boeing have seen large net cancellations of jets just simply because that's part of the economy the global economy, not just the United States, that it will take years to recover.
Thank you, Joel and Paul, for that. We had a few questions that came in specifically related to national debt. We had a question that came in related to, is expansionary monetary policy the only way to keep economic growth going? And I know that you had mentioned in your remarks inflation, and could be some moderate inflation as opposed to deflation. Are there any concerns about debt or looser fiscal or monetary policy, or what are some of the trade-offs there or risks, either for monetary policy or fiscal policy?
I'll take a crack at that first and then hand it back.
Sure.
First of all, monetary policy is pedal to the metal for the foreseeable future. There's very little more that the Federal Reserve can do, and the take-up rate on many of its emergency loan programs is low. There's lots of capacity left there if it needs to be used. The real policy crux is, what is fiscal policy going to do? Because under current law, the stimulus that's already been passed is going to fade. So a lot of the attention is really not on how accommodative monetary policy is going to be. That it's going to be accommodative for a long period of time, but how stimulative fiscal policy we're going to be. I don't think there's any immediate concern about deficits and debt. CBO estimates that the consequence of the pandemic is essentially a one-off increase in the level of debt, with deficits thereafter returning close to the pre-pandemic path, okay, in part because there has been such a large decline in interest rates that looks like it will be persistent for several more years, so that the debt service relative to the size of GDP is not going to rise. Now, much further down the road, we face long-term fiscal imbalances that will ultimately have to be addressed, but I'm not concerned about the inflationary implications or the implications of debt crowding out private sector investments over a forecast horizon of 10 years.
Again, I absolutely agree with Joel. Monetary policy is mostly tapped out now. If you look at the yield curve, interest rates are very, very low, out to 5 and 7 year yields, treasury yields. There isn't an awful lot more the Federal Reserve can do to lower those. So the only game really in town is fiscal policy. As long as interest rates on borrowing costs on that debt remain low, there's no problem. As Joel notes, it's very important to make clear that interest costs on that debt are actually lower than they were pre-pandemic, even though the debt is now significantly higher because of how far interest rates have fallen. And I do think that if there is a risk of that higher debt causing higher inflation and having a negative impact on economic growth, it is a long way down the line. It's a 5 to 10 year time horizon rather than the next couple of years. And even then, it's worth it because, the alternative was to do nothing now and have a much worse impact on the economy and a much more severe recession now. Joel noted in his remarks that he thought without the policy stimulus, GDP would have been 5% lower. The CBO recently came out with estimates that they thought the stimulus added 4% to GDP this year and will add a further 3% next year. Without that, we would have been in an even bigger hole. So it's certainly a risk I'd be willing to take in the future. And anyway, relative to other countries, US debt, federal debt, is going to move above 100% of GDP in net terms, maybe even over the next few years get to 110. But that still leaves it well below the levels in some other countries like Japan and Italy, which are also still have unusually low borrowing costs. So there's no reason to fear that we're going to see an immediate rise there.
Thank you very much, Joel and Paul, for the answers to the questions from the audience. And with that, we heard some discussion in both of your remarks about the international aspects, and we're going to turn to that next, to our second session today. So our second session today covers the global economy, with a focus on economic drivers and outlook, particularly in key regions of OECD Europe, China, and India. And we're grateful again to have three very distinguished guests on this panel. The first speaker is Ben May, who is Director of Global Macro Research at Oxford Economics. He is involved in the production and presentation of the company's global macroeconomic views with a leading role in covering advanced economies. And he has also worked on their Eurozone team. Prior to joining Oxford Economics, Ben worked at Capital Economics in the Bank of England. Second, we'll hear from Joydeep Mukherjee, who is Managing Director of Standard & Poor's Global Ratings. He is currently the sector lead for sovereign ratings in the Americas. Joydeep has worked with credit ratings in Asia and the Western Hemisphere. Before joining S&P, he worked for CIBC Wood Gundy, a consultant to the Asian Development Bank, and the Legislative Assembly of Ontario. And our final speaker is Peter Nagel, who is Senior Economist in the World Bank's Prospects Group, where he co-authored the Commodity Markets Outlook report. In addition to commodity markets, his research interests include debt and financial crises. Previously, he worked at the Bank of England, where he focused on macro financial developments in the euro area. We're very excited to hear their thoughts. So with that, let me hand the speaking over to Ben to get us started.
Thank you. So the economic costs from the COVID-19 outbreak and the associated lockdowns have been enormous. GDP falls of up to 20% or so in Q2 experienced by some economies were far greater than most initially envisaged as well, as the previous guys noted. But at the same time, the post-lockdown bounce in activity has also seemingly surprised economists to the upside as well. Indeed, we estimate that Chinese GDP is already back to pre-crisis levels due to the fiscal stimulus measures implemented there and a relatively strong export performance. The latter is in contrast to the collapse in global trade and partly reflects China's early emergence from lockdown and perhaps the sort of re-emergence, if you like, of its supply chains. But there's also been high demand for goods of which China is a major producer, such as personal protective equipment, PPE, and also electronics equipment that people have perhaps gone and bought out in response to working from home. Elsewhere, we think the recovery to pre-crisis levels of GDP will clearly be a lot less speedy. Nonetheless, we've seen a slew of economies who look set to rebound very sharply and record quarterly expansions in GDP of around 10% or more in Q3, which certainly makes past post-recession bounces look very sluggish by comparison. Elsewhere, the recovery to, but there are also signs, I think, that post-crisis bounce is beginning to fade. At Oxford Economics, we've got various recovery trackers, and they have sort of consistently across economies started to level off. And they seem to confirm that a second slower growth phase at a global level is now beginning. So looking ahead then, perhaps the first sort of key issue is how quickly will GDP return to sort of pre-crisis peaks. Certainly our baseline view for the global economy is conditional on the assumption that from here, lockdown restrictions, certainly at a global level, gradually do ease. And this really rests on the idea that policymakers will find better ways to limit the spread of the virus, such as test and trace, that perhaps lessen the need for much blunter restrictions on activity and movement, with the sort of extreme version being national lockdowns. We also assume that around the middle of next year, we're sort of making quite tangible progress towards a vaccine, which once again will allow a further return to normality. So against this backdrop, we assume that firms currently operating far below pre-crisis capacity levels due to the various COVID restrictions can gradually increase production, and that many of those workers who have lost their jobs or been put on some form of furlough type scheme will resume working too. This employment rebound, along with an unwind in some of the unplanned rise in savings during lockdown, certainly bodes well for consumer spending. And while easing government support for households will certainly be a headwind, we certainly expect solid consumer spending growth over the coming quarters around the world. Certainly the outlook for the corporate sector is perhaps rather less positive. Although the health of corporate balance sheets may not have been flashing red before the COVID crisis, the financial data was nonetheless a cause for concern in many places. And against this backdrop, that surge in debt that we've seen around the world as firms have had to borrow money to cover those revenue shortfalls, it's certainly a worry. It's also worth noting that lots of people have talked about that the associated increase in money supply as being a cause for concern on the inflation front. But certainly our view is that most of that money is either being used to cover those revenue shortfalls or actually sit on firms' balance sheets in case of future problems. I think many firms have probably gone out to borrow in anticipation that credit conditions may well tighten in the future, and certainly there's signs that has occurred. But even if we start to see a situation where uncertainty unwinds, social distancing measures increase perhaps even a little bit more quickly than we're assuming, certainly we don't envisage firms going out on major spending sprees. And indeed, there's already evidence out there that firms around the world who've perhaps done less badly than feared during the crisis period are starting to repay that emergency support measures. So really it looks like, for now at least, firms are going to be concentrating on cutting costs, shoring up their balance sheets, being in a stronger position if we see renewed problems for the global economy, rather than looking to spend any of that money on investment and other things that could ultimately be good for growth going further ahead and also perhaps encouraging inflation. So putting all that together, on balance, we certainly expect solid growth by historical standards in 2021 at a global level. We're sort of seeing the average quarterly pace of growth. I use that term just to get away from the nasty base effects that distort the annual growth rates. We're sort of seeing that sort of underlying pace of growth being quite similar to what we saw in 2010 after the global financial crisis. So pretty good growth, but certainly given the scale of the falls in GDP, perhaps that's somewhat disappointing. While we expect global GDP to reach its pre-crisis peak in the latter stages of 2021, a lot of that is really down to China, where GDP is likely to be substantially above the end 2019 levels by that point. For other emerging markets and advanced economies, it's going to take a lot longer, perhaps very late 2021 for the best, early 2022, or even late, even into 2023 or beyond for some economies that have been hit particularly hard. I think given the size of the GDP losses, in some senses a sort of 18 to 24 month period to recover that lost ground doesn't sound like a complete disaster. But the time it takes to recover the lost output doesn't really tell us anything about the scale of the medium-term costs of the virus outbreak. In many ways, that sort of pre-crisis return is quite a meaningless concept, I think, in some senses. And that really brings me up to the second key economic issue of the day. How significant will the economic scars from the COVID-19 outbreak be? In short, one way of assessing it is really to look at the plausible medium-term costs by comparing our current global GDP forecasts to those that we made in sort of early January of 2020. And based on that, but even in 2025, we sort of see global GDP being sort of 2 to 3% lower than our projection that we made 9 months or so ago. And we sort of would attribute that really to be sort of the medium to longer term costs of this COVID outbreak on the global economy. And really there's a number of factors that are down to that. So there's the higher structural unemployment caused by all of this. In a similar way, there may well be some stranded assets caused by COVID-induced structural shifts in demand. Certainly weaker investment will have an impact not only on the capital stock, but perhaps productivity. In a similar way, we're likely to see a rise in the number of zombie firms, which once again tends to be associated with lower productivity. And then finally, we may well see things like increased precautionary savings by firms and households, which once again will lead to weaker economy. The final
With
point.
that, then, we're actually getting to your end of time here, so if you want to wrap it up with the final point, that'd be perfect.
Just what despite this sort of relatively gloomy outlook, we certainly think risks remain firmly skewed to the downside. In addition to second waves of COVID-19, there's certainly risks that we could see things like financial crises emerging, which could obviously have renewed impact on the activity. So really, despite that, certainly risks remain firmly to the downside. So just generally speaking, we really feel that the sort of trends of the last decade of low inflation, low growth, and rock bottom interest rates are here to stay once again for the global economy. So thank you for that.
Well, thank you very much, Ben, for kicking us off in this session. I'd like to pass it over now to Joydeep.
Thank you very much. I'll try to give an overview of how we've seen the world from a credit rating angle after the pandemic started, and then maybe specifically focus on a couple of countries. We reviewed the entire portfolio of all our sovereign ratings, and as you can imagine, many sovereign ratings went down or went into with a negative outlook, and more than half have not gone down. We should make that point. There's some good news. Not every sovereign suffered a downgrade. But it won't surprise you to know that most of our negative rating actions happened in emerging markets and amongst countries that have a rating that's not in speculative grade. That's in speculative grade, not in investment grade. So basically, countries that were already more vulnerable to begin with suffered the most in terms of the hit from this pandemic. If you look globally, the rating actions reflecting erosion of public finances, growth prospects, all of those things are quite common in Latin America and sub-Saharan Africa. If we compare that with Asia Pacific actually from this rating point of view has not really suffered very much. There have been a couple of actions here and there, but basically consistent with the GDP growth story that I think we have for the world, the Asian region, not just China, has held up better, or at least has better prospects of coming back with less damage. Sub-Saharan Africa, Latin America, for structural factors, because they were weaker to begin with. In many cases, they had were dependent on external capital more than other parts of the world, and their basis for economic growth, their legs of growth, so to speak, were weaker, often dependent on commodities or global cyclical factors. So that's the broader panorama that long-term damage for economic growth, hence demand for energy, would be more in those two regions, less so in Asia. Within Asia, let me focus more on India. India has been growing at a very rapid rate for the last, almost say 25, 30 years, 6-8%, depending on which time period you look at. And the Indian economy had gone into a downturn, and it was growing at sort of around 4 to 5%, 4.5% before the pandemic hit. And of course, now, like with everybody else, that economy will contract. We think it'll contract around 9% this year. It'll probably come back next year around 10%. But just like many of the speakers before have said, these numbers are subject to a lot of uncertainty. And it's best not to think really of growth rates during these abnormal times. It's best to sort of think, when do you go back to the GDP that you had in 2019 and sort of start having new growth again? And probably in the case of India, as in many other countries, it will not be in 2021. It'll probably be sometime in 2022. So our focus, not just in India, but all the other countries we look at, including Latin America, is in number one, what is the extent of damage this year and recovery next year? But more importantly, since we're looking at long-term developments, we're looking at sovereign credit ratings, we're looking at the trend rate of growth, the underlying flexibility of the economy once the pandemic is largely over. And that's difficult to do because, you can say, what is the trend rate of growth in the United States after 2022? To what extent has the economy been scarred, either by misallocation of capital or redundancy of capital in certain sectors, or potentially because of the labor market going through trauma, and you know how long it takes to reallocate people into new jobs. So given that caveat, I would say we're still relatively optimistic about the growth rate in India compared with some other parts of the world. And once the trauma is over, let's say starting in 2022 and 2023, in that period, the growth rate, we think it'll probably be around 6%. And again, with some variation around that mean. And the reasons for that have to do with structural features, which I think are still better in Asia in general than in the other regions I mentioned, and certainly quite strong in India. Meaning that there has been a lot of progress with economic reforms. And we've seen in many parts of Asia, but especially in India, the government has not gone backwards in terms of policy because of the pandemic and the recession. Quite the contrary, this has been a good excuse to go forward, to seize the opportunity that's in a crisis. And many countries have done that. You can actually distinguish around the world between countries that have gone into firefighting mode just to prevent things from getting worse, and countries that are using the crisis as an opportunity. So I'll just mention three things that have happened there. One is a major reform of agricultural laws to open up the sector for more market forces. The second is a labor reform to loosen the labor market and overcome some of the rigidities which have prevented India from developing a manufacturing base that we've seen in East Asia and Southeast Asia. And the third is a more general trend of companies trying to diversify out of China parts of their supply chain, either the new parts or some of the existing parts, shifting elsewhere. A lot of that's going to Vietnam, some of it's going to some other Southeast Asian countries, but some of it is now going into India as well. And they're making a serious effort to attract that. So you can argue about the efficacy and timing of these efforts, but there have been efforts to boost growth in the long term. Against that, I have to cite some handicaps. One is, just like many other countries, a huge public debt. It's going to be around 80% of GDP, which is quite large. It's manageable, but it's going to have a cost, meaning governments will have less money to spend on it, on investment. Also, the financial system in India is quite weak, and it will require some government capital injections in the next year or two. So the later that happens, the later the recovery happens. So there's a risk there as well. And also, I guess in general, you could say, with the world economy in bad shape, even countries like India, which are not as export-driven as some countries in East Asia, will suffer from poor global growth. But on the whole, it should be one of the better performers. I think Asia in general, especially East Asia, would probably be the only part of the world where GDP at the end of 2021 will be much higher than in 2019, not just China, but we might see a few other countries as well. But as I said, for Latin America and Sub-Saharan Africa, I think are at the back of the line in terms of recovery. So let me stop there.
Well, thank you so much, Joydeep, for sharing the thoughts. That was quite insightful. I'd like to pass it over now to Peter.
Thank you, Nicholas, and thank you, Ben and Joydeep. As Paul said in the first session, the difficulty in going last is that you have to think of some original things to say, so hopefully I can add some more flavor to the story. So I completely agree with how Ben characterized the recession and the recovery. I think one thing that the World Bank is particularly concerned by is this sort of lasting scars and how the level of GDP is likely to be permanently hit by COVID and the kind of impact it's had on long-term growth prospects. I think the recession we've seen is also quite unique in terms of how it's occurred. The lockdown measures that we've seen have meant it's really hit services to a much greater degree than you see in any other recession, which typically are more focused on manufacturing or investment like the economy. And as I'm sure you know, in the EIA, there's had a massive impact on transport and therefore on oil demand. So pretty striking changes there. And it's also varied quite significantly between countries. So as Ben said, China looks to have pretty much recovered all of the ground it lost in activity because they're back at, if not above their pre-pandemic levels, whilst other countries are in a much worse place and seeing second wave and renewed lockdown measures. And if you kind of look at this in the lens of commodity prices, you still really see these different trends reflected in the different outcomes for commodities. So, for example, with oil, we saw a massive fall in prices, perhaps the largest one-month fall on record in April, We've seen a partial bounce back, but they're still around 30% lower than they were prior to the pandemic. Now, in contrast, metals, their prices are actually above where they were pre-pandemic. And this is purely due to China. China accounts for more than half of global consumption of metals. And so the recovery that we've seen there has really been driving this improved performance. So you're kind of seeing these divergences in economic growth being reflected in different outcomes for commodities. And we're expecting this will continue into the next couple of years. Now, the other thing I briefly wanted to talk about is the green recovery. So this is something that a lot of people are talking about at the moment. It's something the World Bank is very interested in as part of our Building Back Better strategy. And if you think about it, a kind of a recession is, in some senses, the best time to do this. You have the need for enormous fiscal stimulus, so you may as well do it in green infrastructure where you can. Unfortunately, the reality is not so rosy. So there's a group who have been collecting data on fiscal stimulus to the energy sector. There's been around $400 billion in 2020, and unfortunately, more than half of that has gone to the fossil fuel sector rather than to the renewable sector. So what we're seeing is that whilst in theory the green recovery is a nice idea, in practice there's perhaps not as much money going to it as we would like. Now, there are some signs of progress. So, for example, China recently announced its intention to become carbon neutral by 2060. The EU also has plans to become carbon neutral by 2050. And also companies are taking action too. So BP, for example, announced its shift away from oil recently. And just kind of where I want to end on this point from what this means from a commodity point of view, if we do see a shift towards a green recovery, obviously that will be detrimental to the fossil fuel industry, less demand for oil, coal, and so on. I mean, BP kind of potentially called peak oil this year. But it will be very good news for metal commodities. The renewable energy sector is incredibly metal intensive, and it's not just kind of the classic example of electric vehicles need more copper than a gasoline vehicle, but it's across the whole spectrum, so from energy generation to storage to usage. So I think that will be a real increase in divergence as we go forward. Thank you.
Thank you, Peter, for sharing your thoughts. We were very grateful to have all three of you here to share thoughts on such a broad issue such as the global economy. One question might be, I've heard it said that pandemics maybe accelerate trends that are already underway. And we've heard that a little bit with things like reshoring or nearshoring, where people have talked about maybe supply chain, there'd be more pressure on supply chains reshoring. Whereas, in fact, there are other arguments that saying, no, maybe not so fast. But are there some trends that are currently underway that you would see that the pandemic globally is really accelerating? Or are there conversely some types of changes that are happening in the global economy or with people that are perhaps new or that the pandemic has really started? So with that, maybe we could start with Ben and go to Joydeep and then to Peter.
Yeah, I mean, I think we would primarily characterize the way we see COVID as exaggerating or accentuating some of the trends that have been going on for a while. So as I said, it feels to us, whilst there's certainly going to be some supply side effects of COVID-19, we think primarily it's going to lower inflation. We're going to see interest rates remaining lower for a lot longer, and certainly it's likely to weaken potential growth further, obviously from albeit very weak levels. So obviously that, in many ways, exacerbates some of the issues that central bankers, for instance, and governments have been having to grapple with for some while. I'm somewhat less sceptical about it having dramatic impacts on globalization. I think sort of the idea that you could have avoided this by not having factories in China, say, is a misnomer. You can move factories around from place to place, but really that just moves risk rather than eliminates risk. Probably the only way that you can make your supply chain a lot stronger and robust would be to have multiple suppliers who are completely independent around different areas of the world. And in reality, that's very expensive and hard. And in a world where firms are probably looking to cut costs and aren't really working on the assumption of let's make sure we're well prepared for once in a decade, once in a 20-year risks. That doesn't really make sense to do those kinds of things. You're going to probably go out of business before that next shock comes along. So I'm somewhat more sceptical about this sort of end of globalization in response to all of those kinds of things. But I'll leave others perhaps to expand on other things.
Joydeep.
Yeah, I don't have a good answer to your question. It's just something I've been speculating on with other people. If you look at the 1930s during the Great Depression, according to this famous book by Robert Gordon on the rise and fall of economic growth in the United States, he documents quite well the increase in productivity, total factor of productivity, that occurred during the 1930s, which sounds bizarre because you had massive unemployment and massive undercapacity in many, many industries. But it was mainly because of technology and supply side changes that just happened to happen at that moment. And, later on, when demand picked up in the Second World War, suddenly everyone found out the economy could grow really well, not just because you're hiring resources once again, but also because productivity picked up. So I just raised the question, with the disruptions that we've seen so far, I think it's reasonable to say that we're all going faster and faster into digital working and digital technology than we would have. And, it's up to, you hear different specialists say, we've done in 6 months what we would have done in the next 5 years, but we're forced to do this. So, that's a disruption, and I think that this may provide a positive supply shock sometime soon, and not necessarily in advanced countries. It could well happen in some mid-income countries and elsewhere, because you're forced to do something you really hadn't planned to do, or you're going to do it over the next 10, 15 years. So I'm an optimist by nature, and I think perhaps there might be some of this kind of positive disruption on the productivity side to compensate for the scarring that will certainly be there on the side of labor and capital.
Thank you, Joydeep. It's great to hear some optimism after these last 6 months. Peter.
I think that's a really great point. I've seen similar studies which show that after these really deep recessions, you sometimes get a productivity boom because of the factors which have caused the recession. So I agree we need some reasons for optimism at the moment. I think the other angle, and again returning to the commodities side of it, the shift towards working from home, I think, as Joydeep said, has really accelerated what would have otherwise gradually occurred. I know for a lot of companies, they worried that they couldn't do their usual day-to-day tasks remotely, or they didn't trust their staff for whatever reason may be, but they've actually been forced to do it. And in many cases, it was. And so I think this is something that really will stick around for a long time. I think it's definitely more of a factor in advanced economies than it is in some of the emerging markets that we look at. Obviously, you need reliable internet, reliable electricity access. But yeah, I think it's going to have a big impact on oil demand going forward. Many more business trips will be done this way than face-to-face, which is sad in some ways, but perhaps good in other ways.
Well, thank you, Peter. I want to throw one more question. We've only got about a minute, but we have a question on our end about, Peter, I know you had commented about that the green energy might see about less than 50% of the stimulus. Since green energy companies are often startups or companies with narrow or subsidized revenue bases, how well positioned are they to survive the next year or two or to recover the pre-pandemic strength? Maybe we could start with Peter on that. And I know we don't have much time here, but if we do have a moment, Ben or Joydeep, for maybe just a very brief comment on that.
Sure. I think that's a very good question. And I think a lot of the government support packages have been in the form of things like loan guarantees to try and keep these companies going. I think perhaps a critical thing will be, again, as with everything, how long the pandemic lasts. I think if we see a relatively swift return, then that'll be fine. The longer it goes on, the more companies become viable. But I do think that renewables have been relatively insulated. I think it's actually, particularly in the US, coal generators that have really been hit by a reduction in electricity demand. The grid has preferred renewables and gas over coal.
Okay, thank you, Peter. I know we're kind of out of time, but do you have any very brief, pithy thoughts, Ben or Joydeep, on that topic before we hand it over to the other session?
No, I think it's going to happen. It's just a question of, as I said, very soon or a little later, because, yes, if demand is slow for a while and governments don't support these, we might lose a little bit of time. But I think there's just an overwhelming pressure to go in that direction, so it's just a matter of time.
Thank you.
Nothing really for me. I think they've summed it up well.
Excellent. Well, that wraps up the second session. I want to thank Ben and Peter and Joydeep, as well as Joel and Paul from our first session. And with that, I'm going to hand the moderating over to John Maples for the energy sector demand session.
Great. Thanks, Nick. As Nick said, my name is John Maples, and I'm the team lead for Transportation Energy Analysis in the Office of Energy Analysis at EIA. There is a considerable amount of uncertainty surrounding the duration of the pandemic. I hope everybody can hear me okay. I just got something weird with my sound. Anyway, there's a considerable amount of uncertainty surrounding the duration of the pandemic and the impact that will have on the economy, energy markets, and demand behavior. We've heard some interesting insights this afternoon from the macro sessions, and we'll now delve into the demand sector to discuss some of the uncertainties there. Our panelists today will offer their thoughts on potential demand changes in energy demand and demand behavior for the building, industrial, and transportation sectors. Our two distinguished panelists for this afternoon are Jim Sweeney and Whitney Herndon. Jim Sweeney is Professor of Management at Science and Engineering at Stanford University. His professional activities focus on economic policy and analysis for energy and the environment, especially energy efficiency. He is Senior Fellow of the U.S. Association for Energy Economics, California Council on Science and Technology, Hoover Institution, Freeport Institute for Energy, and Stanford Institute for Economic Policy Research. Jim was founding chair of the California Energy Commission's Petroleum Market Advisory Committee and founding director of the Freeport Energy Efficiency Center. Jim earned an MIT's bachelor's degree in electrical engineering and a Stanford PhD in engineering economic systems. Our second speaker, Whitney Herndon, is an associate director at Rhodium Group and manages the firm's U.S. Energy Research. Whitney manages a team of analysts that use a range of energy and economic models to analyze the impact of policy proposals and market shifts on U.S. energy system and the macroeconomy. Her expertise includes carbon capture, energy and electric power systems modeling, and economy-wide decarbonization. Whitney has a bachelor's degree in environmental sciences and molecular biology from the University of California, San Diego, and a master's of environmental management with a concentration in energy economics from Duke University. I'm excited to hear their insights on these critical issues today, and with that, I will turn it over to Jim.
Thank you. I'm assuming you can hear me okay. You'll wave your hands if you're not. First of all, a disclaimer. I don't think we really know anything with certainty about the COVID system, but I will speculate, not try to quantify anything. I believe that the aggregate energy demand that we're going to be seeing post-COVID will be driven primarily by the macroeconomic variables, the ones that we've been discussing in the last two sessions, except for one big issue, oil and transportation, and that's Whitney's territory. That is going on. We may have a very significant loss of one major component of the market for oil. That's in the transportation area. The post-COVID, I think there's going to be little residual impact on the demand for coal and natural gas, other than in the reductions in the aggregate overall economy. I think there'll be impacts depending upon who's elected in the fall, but I'm not going to go there in this discussion. In aggregate, electricity use was seen so far relatively little impact from the COVID in aggregate, but we see electricity distribution systems changing because of the change in which sectors are using the electricity. There's less in the commercial sector, more in the residential sector, but they roughly are balancing so far, and I expect that to be continued post-COVID. The biggest change is something that Peter Nichols has mentioned, and I'd like to talk about this a little bit more. That's working from home, the virtual economy. As of June, about twice as many people are working from home as working from their company. I would bet for the audience of this event, maybe 95% of people are working from home and maybe 5% are working for the company. So I expect there's not a lot of essential workers on this call, but the essential workers are at business, at their offices. For some of them, and some of them, essential workers like my MD that I'm working with, I do more virtual conversations with my MD than I do for in person. Now I'm going to be getting a knee transplant next week, and that better not be virtual. That's going to be. So twice as many working from home as working for companies. That has led to a tremendous amount of learning about the possibility of doing it. Companies who thought that there was no chance of having productive people working at home are finding that they've learned how to manage people at a distance, how to make productivity. And so I expect that that's going to continue because there's a lot of advantages as well as disadvantages from working at home. I think you're going to see in a lot of organizations work perhaps 3 days a week, 4 days a week at home, maybe 1 day in the office. You're going to have what we see now is a blurring of the workday. Now I think of the week starts with Blur's Day and ends with Blur's Day. I think there will be more of a blurring of the home work balance because people don't have the sharp differentiation going into work. This will be particularly true of knowledge and communication work. I'll give some examples. In Facebook, they told all of this more senior employees that they can work permanently at home if they want. Google's doing roughly the same thing. My son, who works in Robert Half, has been recruiting people totally allocationally. He doesn't care where they live in the United States because they can work permanently from home without having to go in there. Even in the medical field, as I mentioned, that's happening more and more. Now, what is this doing to productivity? Nick Bloom has been doing some studies of individual firms and found that for some firms, as people are starting working at home, the aggregate productivity of these people has increased, something like 3 to 5%. They went through some more experiments where people got to choose whether they worked at home or worked at the office. And there was a further increase in productivity because some people worked more effectively at home, some people more effectively with the social environment of work. We even see that in academia. In my own department in Stanford, it's been reported that some of the faculty members seem tremendously more productive given that they never go into the office, and others are feeling a little bit lost and less productive. So there's an individual difference, and we're going to learn how to sort that out over time. What does that mean, though? First, the internet is essential here. If you don't have a good internet connection, you can't work as effectively at home. 5G is going to help for some people, but not for all. So that's going to have to be strengthened in order to move to that trend. Housing market. People are placing more value now in space so that they can have home office from what the kids are doing, and more recreation at home. That means more suburban housing. You know, the housing starts in the suburban housing market is booming now, and I think that's related to COVID. I think that's going to continue afterwards. There's some move from central cities. Some people say that the central cities are going to collapse. I think that's totally wrong. But the growth rate in central cities, I think, is going to slow down as people find that there is some advantage in moving differences. So this will have a shift in electricity demand from central cities to suburban regions. But the aggregate energy demand, I don't think it's going to greatly change because of these things, but the distribution systems are going to have to. There's been a recent Wall Street Journal, just little article, views of CEOs as to whether they think their company is going to be continue to working virtually or back at work. The views were all over the map. The CEOs just totally disagree with it. But one trend is the high technology companies and the companies that were almost all knowledge workers believe that they're going to be almost entirely virtual afterwards. I'd like to just end with one picture about aggregate energy trends, if I can figure out how to share my screen. And, okay, I've sent you the backup. Maybe you can put it on because I can't make this share my screen. John, oops, did I send the wrong thing? Okay, this is what I want, if we can expand that. I want to talk about aggregate energy efficiency, and this is by presidential administration, and I have a Kaya identity that is perfect. Kaya identity that's showing from by presidential administration, starting with the pre-energy crisis before '73, about the terms that lead to carbon dioxide increases in the economy. We could break it into four terms: GDP growth, energy use per dollar of GDP, and carbon dioxide per energy use. That's the aggregate economic growth, the energy intensity of the economy, and the carbon intensity of the energy sector. You notice before the energy crisis, there was almost no energy efficiency going on, no cleaning up of the energy system, so that the carbon dioxide emissions were growing right along the lockstep with the economy. Once we had the energy crisis, this blew as energy efficiency trends by administration. You see, we moved to between about 1.5% and 2.5% per year under every presidential administration, not particularly correlated by political party. And only recently we're cleaning up the energy system, and that's a small part because of the renewables. It's a big part because natural gas is pushing out coal, and the energy system's getting cleaner. So right now we're seeing, starting from Nixon forward and through the Trump administration through 2019, the energy efficiency trends have been in the order of 1.5% to 2.5% a year, basically because at the beginning, energy efficiency was driven at the federal government level. Now it's primarily driven by private sector choices for financial reasons, for profitability reasons, and by state and local governments. I expect these trends are going to continue in energy efficiency as we start cleaning up the economy, and I'm hopeful that we're going to start downward trends some more on this black being the total carbon dioxide rates of growth from the economy. Notice each of these data are on annual rates of growth of each of the variables, with the dominant variable being macroeconomic growth. And on that, I'll stop.
All All right, great. Thank you for those comments, Jim. Whitney?
Thanks, Sean. Okay, thanks, Kelsey. So every year, Rhodium releases our projections of U.S. total greenhouse gas emissions, where we try to focus on being inclusive of the range of economic and market uncertainty that will impact the U.S. energy sector. So obviously, the big one for this year was COVID-19 and the subsequent macroeconomic outlook and impact on the energy sector. So given that Jim covered the building sector, I'm going to spend some time discussing the trends that we've seen in the industrial and transportation sectors, starting with industrial production focused on the manufacturing sectors. So Kelsey, can you go to the next slide? Thank you. Okay, so overall, at the height of the COVID-19 policy impact, industrial sector production declined 17% total in April. April was the month with the most stringent lockdown policies this year, and currently the sector is down 8% in production from this time last year, so over a 10% recovery. There's been a diverse response to COVID-19 from the U.S. manufacturing sector. The largest manufacturing sector in terms of energy consumption, chemicals, was only slightly impacted by COVID-19 compared to other sectors, with a 7% decline in production in May. Likewise, food and beverage production, which is another energy-intensive industry, declined only 10% temporarily and is already almost completely recovered. On the other hand, there's industries like primary metal production, which includes iron and steel. They suffered a large 31% production hit in April, mainly because of the huge temporary hit to U.S. auto sales. This is also evidenced in the chart by motor vehicle production, which declined 84% in April and has already recovered. Though these industries, primary metals and motor vehicles, have already largely recovered, the steel industry has been hit particularly hard because the economics of many steel mills were already on the edge. Lastly, the smaller, more diverse manufacturing firms, including apparel and leather goods, were hard hit by the pandemic and are still really struggling to recover. The main takeaway here in the industrial, specifically the manufacturing sector, being that the smaller, more diverse manufacturing firms were relatively harder hit than the larger, more consolidated, and usually more energy-intensive manufacturing firms. Though the smaller firms altogether do make up about 15% of total manufacturing energy consumption. So given the near-term economic prospects discussed by the previous two panels and factoring in the large amount of uncertainty in the medium and long term, we don't anticipate pre-COVID levels of industrial production to recover until sometime between the mid-2020s to mid-2030s, with diverse production growth rates depending on the individual industries themselves. Okay, switching to transportation. Next slide, Kelsey. Thank you. So I'm going to focus on the three modes that consume nearly 90% of U.S. energy in the transportation sector, so light-duty vehicles, on-road freight transportation, and aviation. So as a proxy for these three modes, we look at gasoline, diesel, and jet fuel consumption, as well as other factors such as VMP, but I don't have VMP shown here. So starting on the left, as Jim discussed a lot, obviously the impact of stay-at-home orders across the country and subsequent teleworking had huge consequences for light-duty vehicle energy consumption. As a result of that, gasoline consumption declined 45% at the height of the shutdown. Unexpectedly, though, for us and many other analysts, it recovered much quicker than anticipated, even though most were still working from home. Currently, gasoline consumption is still 9% lower than this time last year. LDV and subsequent gasoline energy consumption will continue to be one of the hardest sectors for us to predict due to the uncertainty in consumer behavior and the fact that people are still, that BMC has rebounded, but a large percentage of the population is still working from home. On-road freight and diesel consumption has been the least impacted from COVID-19 due to the essential nature of this form of transportation. The largest impact being a 15% decline in in diesel fuel consumption in April and May. And diesel consumption is already, as of last week, higher than this time last year. Lastly, as most people on this call already know, aviation has been one of the hardest hit sectors in the U.S. economy. This has resulted in a 69% decline in jet fuel consumption at the height of lockdowns. And the industry is still suffering, though has had about a 50% recovery, and currently jet fuel consumption is on a 38% decline compared to last year. We do, obviously, the caveat being, there's a ton of uncertainty in how the economy and the subsequent sectors are going to recover from COVID-19. But we think that air travel will mostly recover by the mid-2020s, but that it will still remain below 2019 levels for at least the next 10 years. And that's it.
All right, great. Thank you, Whitney. So we have some questions that have come in, and I think, Jim, even though you didn't specifically talk about transportation, if you want to comment on some of these that are transportation related, please feel free to do so. So one of the first questions I got was this interest in how, since vehicle sales have seemed to have recovered pretty well, I guess any of the thoughts you might have on how this might impact electric vehicle sales, if you think this would be a positive thing for electric vehicles, or if the overall COVID pandemic might turn out to be more of have a negative impact on electric vehicle sales.
I actually think public policy is like California, that's trying to force more electric vehicles in that state, is going to be important. I don't think COVID makes much difference if you're buying a new car, whether you want an electric vehicle or an internal combustion engine, so I don't see a big impact there. But I do see a public policy impact pushing towards electrification.
Thanks, Jim.
I think one of the concerns, John, is that there will be less vehicle turnover as a result of COVID-19, and specifically because people are commuting less and less likely to buy a new car is one of the concerns. And obviously, in that instance, there would be less new car sales, which would impact the sale of electric vehicles as well. So, I mean, it's very uncertain how scrappage will be affected still, but it could potentially be negatively impacted if scrappage rates slow down.
Great, thank you. One of the other questions we got, and I think this was related to Jim, your comments on teleworking and those who have access or are better suited to do that. The question is, as a nation in this ongoing pandemic, how do we keep those essential workers informed, educated, and still connected to those workers who have the flexibility to get connected via internet? Are we creating a communication gap that will hurt us as a nation in the near future?
Wow, that's such a deep question. Let me just give a couple of issues. The digital gap seems to be getting larger, and we're seeing it through the educational system. That's a COVID effect. Post-COVID, I think kids are going to be getting back to school, and you don't have that. Once we have past the COVID, at this rate, late in 2021, where hopefully we'll be fully past COVID, then it's going to be a matter of choice of the companies where they more effectively have you working. Can you work at home effectively, and can you work at the office effectively? And that you will still have, I think that in itself isn't going to lead to an impact other than people aren't talking to each other as much. There's not the casual conversation. In my office, I ran into one of our janitors I really enjoyed, and we had a conversation all the time. I don't run into that person anymore, so there's less social mixing now because all of my communications now on the telephone are purposeful. And the purposeful conversations are with people who tend to have some more commonalities with me. So I think that we're going to lose something with them working at a distance in terms of social integration.
Great, thank you. Whitney, do you have any comments on that?
I think Jim did a good job covering it.
Okay. So another question I have is on the industrial sector, and this is whether the pandemic could accelerate trends that are already happening in some industries, such as moving away from primary production of metals to more recycling.
Definitely. Like I mentioned, primary steel production, the economics in the U.S. were already kind of favoring using recycled metals. It depends on the use, of course. We will still need some primary production. But particularly for industries or firms where they were already struggling to begin with, and not just in metals and iron and steel, but elsewhere in the manufacturing sector, we've seen a lot of shutdowns, more older, more inefficient facilities shutting down. So there will be some permanent impacts there, and definitely those were trends that were already happening but accelerated by COVID-19.
Great, thank you. I think this will be the last question, and I think I want to circle back to this issue of telework and what some of those impacts could be. And so I'm going to do this in two parts, one on the building side and then one more on the transportation side. And so the question is, do you have any insights into the types of structural shifts that might occur in the commercial sector if telework on a large scale continues long term? And again, I would just also reflect that how that change in where people decide to live and how they're commuting and what the mobility needs are. So I think both on the commercial side, the commercial buildings and residential building side, and then on how that could affect personal travel and also freight travel for that matter. So whoever would like to go first.
Whitney, why don't you take that first? Because
sure, I will. So I think it's important, John, when we think about analyzing the energy sector, it's really easy to kind of get caught up in the interesting changes that are happening as a result of the pandemic. But we also have to step back and think about how that really impacts the total energy consumption of the individual sectors. And so the example here with commercial buildings is, at first we hear everyone's teleworking, no one's going to their offices anymore, and there is kind of a tendency to think that it's going to be a huge impact on commercial energy consumption. And not that it hasn't been influential, I'm not saying that by any means, but relatively speaking, office buildings, they're not the largest component of commercial buildings. So sorry if you guys can hear my dog. But even those structural changes that are going to occur, I think that in large part the makeup of commercial buildings and the commercial energy consumption will still stay the same. Another aspect of this is the implications for lockdowns throughout the country and the geographic diversity of those lockdowns, and that also is a big, when factored into energy consumption, a big thing. So, for example, in the Southeast, a lot of the lockdowns were not as severe, and that here we actually have make up a large share of commercial energy consumption. So all those factors kind of go into the headline initial thought of what you would think for commercial energy demand not actually being as impactful, because there's so many more factors that go into commercial energy demand besides just office buildings in the locations where the lockdowns were the most severe.
Let me just toss in just a couple of thoughts. I think everybody's now learned that they actually can buy a wide range of things online without having to go to local stores. Much broader group of things than they believed in the past. So I think we're going to have a significant decline in retail stores that people use and continue even after COVID online. Not just the Amazon of the world, but by the broader range of other companies that are going to do that. I think that's going to continue. I think maybe half, at least in California, maybe around other places, probably about half the restaurants and bars or more are going to go bankrupt. They're going to go out of business. But others will get created post-COVID, but their locations will probably change. There'll be less of them serving the big office buildings and more of them serving more suburban areas where people are living, or around places where people are living rather than when they're working. So I think that's the retail sector is going to have some the retail and the restaurants and the bars are going to have fairly long-term, significant, at least in locations, and in absolute quantities for the type of retail stores.
Okay, thank you very much. So it looks like we're out of time, so I'm going to stop us here. I want to thank you both very much for your insights today and for participating in this session. Thank you very much. I also want to thank everyone for their participation today, and a thanks to all of our panelists that were on the workshop today. Kelsey, if you don't mind, will you put up the slide that shows people the information for the upcoming workshops? Just as a reminder for folks. So we have 2 more workshops in this series. The Petroleum and Natural Gas Markets Workshop is coming up on September 29, and the Electric Power Markets Workshop will precede that on October 1st. So if you weren't aware, here they are. I encourage you to sign up and participate. If you have any follow-up comments or questions, we can be reached with the Annual Energy Outlook mailbox. That's annualenergyoutlook@eia.gov. Again, I want to thank everybody for your participation today. And with that, I will conclude the workshop and wish everyone to have a great rest of your day. Thank you.